$100,000. That is what a 2025 NerdWallet analysis found the average person loses over their lifetime from a single common mistake in their 20s. Carrying credit card debt instead of putting that same money into an investment account. One decision, $100,000 gone. And most people never even realize it happened because the damage is invisible. It is not a bill you see, it is money you simply never had the chance to grow. Here is the harder truth. That is just one mistake. There are 7 of them, and most people in their 20s and 30s are making at least 3 of the 7 right now without knowing it. In this video, I am going to walk you through every single one, with the real dollar cost of each mistake and the exact fix, in the order that matters most for your age and situation. By the end, you will know precisely which of these mistakes is draining your future wealth the fastest and what to do about it starting this week. I want you to stay until mistake number 5, because that one alone accounts for more lost wealth over a lifetime than almost anything else on this list, and almost nobody talks about it. Every number in this video comes from real studies. The Federal Reserve, NerdWallet, Vanguard, and Bureau of Labor Statistics data, not guesses. This is not about shaming you for mistakes you've already made. Everyone makes some of these. This is about making sure you are not still making them 5 years from now when the cost has multiplied. Let's start with the most common one, the one nearly everyone in their 20s makes without even thinking about it.
The single biggest mistake in your 20s is not a bad investment. It is no investment at all, because you convinced yourself you needed more money before you could start. Here is the actual cost of that delay. If you start investing $200 a month at age 25, at a historical average return of 10% annually in a broad stock index fund, by age 65, you would have approximately $1.1 million. If you wait until age 35 to start the exact same $200 a month, you end up with roughly $400,000. 10 years of waiting costs you $700,000. That is not a typo, and that is not because the market changed. It is because compound interest needs time more than it needs a large starting amount. The reason people delay is almost always the same. They think investing is for people who already have thousands of dollars saved, or they are waiting to feel financially ready, which usually never actually arrives. But you do not need thousands of dollars to start. Most major brokerages now let you open an account with $0 and buy fractional shares of index funds for as little as $5 or $10. The fix is simple and almost embarrassingly small. Open a Roth IRA or a brokerage account this week, even if you can only put in $25 to start, and set up an automatic transfer of whatever amount you can genuinely afford, even if it is small. The amount matters far less than starting the clock, because time is the one input in this equation you can never buy back later. Someone who invests $50 a month starting at 22 will very likely out-earn someone who invests $200 a month starting at 35, purely because of the extra 13 years of growth. If you take away one single action from this entire video, let it be this. Open the account today. Put in whatever you can and let time do what no amount of money later can replace. This is the exact mistake from the statistic at the start of this video. So let's break down why it is so devastating. The average credit card interest rate in 2025 sits around 22% annually, according to Federal Reserve data. Now compare that to the roughly 10% you could be earning if that same money were invested instead. When you carry a balance, you are not just paying interest, you are paying a rate more than double what you could be earning elsewhere, which means every dollar trapped in credit card debt is actively working against you twice as hard as it could be working for you. Here is a concrete example. A $5,000 credit card balance at 22% interest, making only minimum payments, takes over 18 years to pay off and costs more than $7,000 in interest alone, meaning you pay back over $12,000 for something that originally cost $5,000. The fix has 2 parts. First, if you are currently carrying a balance, treat it as the single highest financial priority, above almost everything else, including investing beyond an employer match, because no investment reliably returns 22% to outpace that interest.
Use either the avalanche method, paying off the highest interest rate card first, which saves the most money mathematically, or the snowball method, paying off the smallest balance first, which builds motivation through quick wins. Both work, and the best method is the one you will actually stick to. Second, and this is the part people skip, once the balance is paid off, keep the card open and pay it in full every single month going forward. Because a credit card used responsibly, paid in full, actually builds your credit score, which saves you money later on car loans and mortgages. The goal is not to avoid credit cards forever. It is to never again pay 22% interest on money you could have invested at 10% instead.
The average new car payment in the United States crossed $730 a month in 2025, according to Edmunds Auto Data. And for the first time in history, that number is now higher than the average rent payment in many parts of the country. Here is the real cost most people never calculate. A $730 monthly car payment, if invested instead over just 5 years at a 10% average return, would grow to roughly $56,000. Most people replace their car every 5 to 6 years, which means this is not a one-time cost. It is a repeating pattern that can quietly cost hundreds of thousands of dollars over a working lifetime. The trap is that a car payment feels normal because everyone around you has one. But normal is not the same as smart. The fix is not necessarily to never buy a car. It is to buy based on a rule that protects your future wealth. A widely used guideline among financial planners is the 24% rule. Your total car costs, including payment, insurance, and maintenance, should not exceed 24% of your monthly take-home pay. And ideally, the car itself should be paid off within 3 years, not stretched to 7 or 8 to make the payment look smaller. An even more aggressive but powerful approach used by many people who build wealth early: buy a reliable used car, 2 to 4 years old, in cash or with a short loan you pay off fast, and drive it for 8 to 10 years instead of replacing it every 5. The difference between a new car every 5 years and a reliable used car driven for 10 years can easily be worth $400,000 over a career, once you account for what that difference could have earned if invested instead. Your car is transportation, not a wealth statement. And the moment you separate those two ideas, this becomes one of the easiest mistakes on this list to fix. If your employer offers a 401k match and you are not contributing enough to get the full match, you are turning down a guaranteed, immediate 100% return on your money, something that does not exist anywhere else in personal finance. Here is how it works. A common match structure is 50 cents on the dollar up to 6% of your salary. Meaning, if you earn $50,000 a year and contribute 6%, that's $3,000 from you, and your employer adds another $1,500 instantly, for free. A 2025 Vanguard retirement report found that roughly 1 in 5 eligible employees contribute less than the amount needed to get their full match, effectively leaving free money unclaimed every single paycheck. Over a career, someone who consistently captures a full match versus someone who contributes nothing can end up with a difference of several $100,000 by retirement, purely from money that was offered for free and simply never claimed. The fix is immediate and requires no complicated decision-making. Log into your benefits portal this week and check 2 things: what percentage you need to contribute to get the full match, and what percentage you are actually contributing right now. If those 2 numbers do not match, increase your contribution to at least the match threshold before you do anything else with extra money, including aggressive debt payoff beyond minimum payments or additional investing elsewhere, because nothing else in your financial life offers a guaranteed instant 100% return. This is the single lowest effort, highest impact fix on this entire list. It takes about 5 minutes to check and adjust, and the financial impact compounds for the rest of your career. Here it is, the mistake that quietly does more damage than almost anything else on this list, because it disguises itself as success. Lifestyle inflation is what happens when your spending rises at the same pace as your income. So every raise, every promotion, every bonus gets absorbed into a slightly nicer apartment, a slightly nicer car, more takeout, more subscriptions, and your actual savings rate never improves, no matter how much more you earn. A 2025 Bureau of Labor Statistics Consumer Expenditure Survey found that households earning over $100,000 a year, on average, save a smaller percentage of their income than households earning $60,000 to $75,000 a year who developed strong saving habits earlier and never let their lifestyle catch up to later raises. Let that sink in. Earning more does not automatically mean building more wealth, because wealth is built from the gap between what you earn and what you spend, not from the income number itself. Here's a real example. Two people both start at $45,000 a year, and both reach $90,000 over 10 years through raises and promotions. Person A increases their spending every time their income rises, so their savings rate stays around 5% the entire time. Person B keeps their lifestyle roughly the same as their income grows and increases their savings rate to 25% as raises come in. After 10 years, Person B has invested contributions worth well over $100,000 more than Person A, despite earning the exact same total income over the decade. The fix is a simple rule used by people who build wealth quietly. Every time you get a raise, split it. Put at least half of the new income increase directly into savings or investments before you ever see it in your regular spending account, and only let the other half upgrade your lifestyle. This way, your life does genuinely get better with every raise, but your wealth grows just as fast, instead of your savings rate silently staying flat or shrinking while your income rises around it.
A 2025 Federal Reserve survey found that 37% of Americans could not cover an unexpected $400 expense without borrowing money or selling something. That statistic matters because life was not asked permission before it throws a car repair, a medical bill, or a sudden job loss at you. And without a cash cushion, every one of those normal life events turns into new debt, usually at high credit card interest rates, which then triggers mistake number 2 all over again. Here's the compounding cost. Without an emergency fund, the average unexpected expense gets put on a credit card. And if it takes a year to pay off at 22% interest, a $400 emergency actually costs closer to $450 to $500 once interest is included. And if it happens repeatedly, which it does for most people without a fund, that pattern can add up to thousands of dollars in unnecessary interest over just a few years, on top of the constant stress of never feeling financially stable. The fix follows a specific order, not a vague goal to save more. First, build a starter emergency fund of $1,000 as fast as possible, even if it means pausing extra debt payments or investing temporarily. This first layer prevents most small emergencies from becoming new debt. Second, once high-interest debt is handled, build up to 3 to 6 months of essential expenses, kept in a high-yield savings account, not invested in the stock market, because this money needs to be stable and instantly accessible, not growing. Its entire job is protection, not returns. A realistic target for most people is somewhere between $10,000 and $20,000 fully funded, but the starter $1,000 is what actually stops the debt cycle, and that first layer alone can be built in 1 to 3 months if you treat it as the priority it actually is.
This is the mistake with the biggest single decision cost on the entire list, because unlike spending habits, it happens at just a few specific moments, but those moments compound for the rest of your career. A 2024 study from Fidelity Investments found that only 42% of people negotiate their salary when offered a new job, and the ones who do not negotiate leave an average of $5,000 a year on the table compared to what they could have gotten by simply asking. Here's why that number is so much bigger than it looks. Every future raise, bonus, and job change is typically calculated as a percentage increase from your current salary, which means an unnegotiated starting salary does not just cost you $5,000 once, it costs you a percentage of $5,000 every single year for the rest of your career, plus every retirement contribution calculated as a percentage of that lower salary. Over a 40-year career, failing to negotiate even one starting salary can realistically cost more than 6 figures once you account for the compounding effect on every raise that follows. The fix is simpler than most people think.
Because employers almost universally expect some negotiation and build room for it into their initial offers. When you receive an offer, the single most effective sentence you can say is some version of, "I'm excited about this role. Based on my research and experience, I was expecting something closer to a specific number, 5 to 15% higher. Is there flexibility there?" Most companies will either say yes or come back with a number in between. And in the rare case they say no, you have lost nothing by asking. This applies not just to new job offers, but to annual reviews too. Bringing a documented list of your accomplishments and asking directly for a specific raise percentage rather than waiting to be offered one is how people consistently out-earn equally skilled peers who simply never asked.
You have now heard all 7 mistakes, but here is the part that actually matters. You are probably not making all 7, so which one deserves your attention first? A simple way to prioritize is by asking which mistake is currently active in your life versus which ones are already fixed. If you are carrying high-interest debt right now, that is always priority 1, because 22% interest is actively working against every other financial goal you have. If your debt is under control, but you are not capturing your full employer 401k match, that is priority 2, because it is the fastest, lowest effort fix with guaranteed returns on this entire list. If both of those are handled, look at your last 3 raises. Did your savings rate actually go up, or did your spending simply rise to match? If it stayed flat, lifestyle inflation is quietly working against you every single month, even though nothing feels obviously wrong. And if you have less than $1,000 in accessible savings, you are one unexpected expense away from restarting the debt cycle, no matter how well everything else is going. The honest truth is that most people in their 20s and 30s are dealing with 2 or 3 of these at the same time, and trying to fix all 7 simultaneously usually leads to fixing none of them well. Pick the single mistake from this list that is costing you the most right now, based on what is actively happening in your life today, not the one that sounds the most interesting, and give it your full attention for the next 90 days before moving to the next one. Financial progress is not about doing everything at once. It is about fixing the biggest leak first, then moving to the next one, in order, consistently. Let's recap the 7 mistakes. Not investing because you feel you don't have enough. Carrying high-interest credit card debt, buying more car than you can afford, leaving your employer 401k match unclaimed, letting your lifestyle inflate with every raise, having no emergency fund, and never learning to negotiate your salary. Individually, each one seems small enough to ignore. Together, they are the difference between reaching your 40s financially stressed or reaching your 40s with real growing wealth. And the gap between those 2 outcomes is rarely about how much someone earns. It is almost always about which of these 7 patterns they caught early and which ones they let run for another 5 or 10 years. If one of these mistakes made you a little uncomfortable while you were watching, that discomfort is useful information, not something to brush off. This week, do one specific thing. Pick the mistake that is costing you the most right now and take the smallest possible first step. Open the investment account, check your 401k match percentage, or write down what you'll say the next time you're offered a raise. This is for education, not financial advice. Think through your own specific situation before making financial decisions. If this video helped you see where your money is quietly leaking, that is exactly what it was made for. Thank you for watching, and I will see you in the next one.